Come to this problem. A holds the following portfolio: share, beta, initial price, dividends, market price at the end of the year. Calculate Epsilon Limited, Sigma Limited, Omega Limited, GOI bonds. A problem like this, many problems are there. I'm solving one. Calculate the expected return, rate of return of this portfolio using capital asset pricing method. The average return of his portfolio given, risk-free return is 14%. The best part about this problem, they asked us to compute the CAPM. Risk-free rate is given, market rate is not given. What to do? Market rate is not given. Practically, we go to index and we calculate. So here what do? We will consider entire list what we have itself is market. In the sense, we compute the market, we compute the return for individual security and then we take an average in the markets. Including the bonds, everything we take market. So let's write that as assumption. Since market rate not given, RM not given, all the shares and bonds given in the problem as in the problem are considered for RM calculation, for calculation of market return, for RM calculation, so one by one we'll calculate. For epsilon, sigma, omega GOI, so their P0 cost. Sometimes here they mention price, sometimes they use the word cost. Please understand, if they use the word cost, it means P0 only. So 25, 35, 45,000, 25, 35, 45,000. What my textbook has is same as what I've given you as the material, except it has solutions, nothing different. So all the questions are part of your book also. Solutions are not there, I'm solving it, and solutions are available in the material as given by ICI. That's all the textbook part is. It has all the answer, whether the extra question or not, it has all the answers. So I can't really say extra questions. So it has a solution for everything, what I do and what I not do, both of them. Okay, so P0 is this. P1, price at the end of the year, 50, 60, 135, 105, 50, 60, 135, 1005. Then D1, dividend 1, dividend assumed to be at the end of the year, 140. So Government of India, that will not be a dividend, it will be a coupon income, but anyways, total. So how much total you get? Please do 25, 35, 60, 105. I think 1105. And here 110, 140, 250. I think 1250. 6 plus 140, 146. So market return RM P1 minus P0 divided by P0 plus D1 also will do into 100. That is 1250 minus 1105 divided by 1250 1105, P0 is 1105 plus 146 into 100. So this practically I will not recommend this because this has a lot of limitations, but for exam point of view, this is what the method approach followed. So let's take this as it is, and this has been asked many times. You can see in the book, so many questions are there, this variety. So 26.33%. So okay, it's RM we got. Let's calculate the CAPM return now. Or CAPM return for which portfolio? So okay, they're asking expert return of office portfolio, and portfolio weights are not given. They said initial price, but how many shares they're not given. So what do? We'll take a simple average. That's all we can do. So we'll compute the CAPM return for each stock. We'll take a simple average. Dividend is for expected return. I am talking about CAPM return. CAPM return requires weights. What is connection between weights and dividends? Weights require number of shares into market price. We don't have that information, so we will take a simple average. Okay. So CAPM return for portfolio. One by one. Epsilon, sigma, omega, and GOI. RF, I think RF is given 14%. Plus RM we got 26.33 minus 14. Beta is given 0.8. Okay, let's just fill up the table, then we'll compute. 14 plus 26.33 minus 14. 14 plus 26.33 minus 14. 14 plus 26.33 minus 14 multiplied by beta values 0.8, 0.7, 0.5, 0.01. 0.8, 0.7, 0.5, 0.01. Okay. Into 0.8 plus 14, 23.864. 22.631. 20.165. 14.123. Okay, so they have asked average return of the portfolio, CAPM return. So take an average, equal weights, assuming to be equal weights. I think the question slightly printing mistake might be there, I think. I mean, answer is fine. Okay, I think the question they said, when they said question, they said the expected rate of return of portfolio. When they meant his portfolio, it means each security. Because again they are asking average return of his portfolio. That both answer can be same. So first part of the question is for each security, second part of it overall portfolio. Okay, so average return, simple average is how much? Sir, 1 second, just give me 1 minute. I'll just verify answer. Average return 20.2, right? I mean 20%. Yeah, 20.1, 20.2% approximately. 20.2%. You can also do by one more method. The beta can be taken simple average. Then you can use the CAPM return to get the answer. You get the portfolio beta substitute in the CAPM return, you get portfolio CAPM return. That is also fine. That also is acceptable method. Okay, hope we can go further. Okay, so come to this problem. This is one of the again repeatedly asked questions. An investor is holding 1000 shares of Fat Lass company. Come to that problem. Fat Lass company. Okay. An investor is holding 1000 shares of Fat Lass company. Presently, the rate of dividend being paid by the company is 2 per share. The share is being sold at 25 per share in the market. However, several factors are likely to change during the course of the year as indicated below. Existing risk-free rate, market risk premium, beta value, expected growth rate. In view of the above factors, whether he buy, hold or sell the shares and why. So basically we have to calculate what is the existing value of the share and what is the based on the revised term, what will be the value of the share. And if the revised term is good, we'll say continue to hold and buy. If revised term is bad, then we'll say sell it off. So under both the methods, we will calculate CAPM return, and based on CAPM return, we'll calculate the value per share. Okay, let's calculate. under existing scenario and revised scenario. Under existing and revised. Let's calculate the CAPM return first. Cost of equity. Okay. Existing RF12. RM minus RF no need to do because they only have given market risk premium. Market risk premium means RM minus RF. So 12 plus 6 into beta is 1.4. The revised value, risk-free rate is 10 plus premium is 4, beta value 1.25. 4 into 1.25. 1.4 into 6 plus 12, 20.4, and 1.25 into 4 plus 10, 15. Okay, let's calculate the equilibrium price, value per share. Value per share. Intrinsic value you can say, or equilibrium price. Using the formula D1 by K minus G, or D0 into 1 plus G. What about dividend? Presently the rate of dividend by company is 2 per share presently, so we'll take it as D0 D1. Very clear. Presently we will take it as D0 presently, so we'll take it as D0. So 2 rupee into 1 plus G. How much is growth rate? Growth rate is existing growth rate 5%, 0.05, divided by K minus G. K we calculate 20.4 minus growth rate 0.05. Under the revised situation, 1 plus growth rate is reduced or increased to 9%, 0.09, divided by 0.15 minus 0.09. So what is the price? $0.154. I think you get 13 something, 13.63. First one 13.63 and second one 2 into 1.09 divided by 0.06, 36.33. Okay, and what is the existing market price? This is equilibrium price. What is existing market price per share? Existing market price per share 25. So in the case of existing one, the price is high. In the case of revised condition, price is less. So this is overpriced and this is underpriced. So recommendation, In case of the first one, existing, since it is overpriced, recommendation is to sell if you have, or if you don't have, don't buy. And revised condition is you buy, or if you already bought, you can continue to hold. Overpriced is sold, underpriced is purchased. You can short sell. That is also one of the things you can do it. Short sell is also fine. Overpriced, you can say short sell. But the concept of short sell and all yet to be discussed, so I'm not told. So just say overpriced, sell. Simple, that is sufficient. Okay, let's go further. Okay, so come to this one. We have discussed that levered beta, unlevered beta, proxy beta, that problem one we have to discuss. So this problem, come to this one. The XYZ Limited in the manufacturing business is planning to merge with a software development company. The project will have a debt equity ratio of 0.27. The company has identified the following for 4 pure play firms in the line of software business. Pure play firm ABC, DEF, GHI, JKL, assuming tax rate applicable to XYZ as 35%, RF as 12%, that is KD before tax as 14%, RM as 18%, you're required to compute WACC to be used to compute the MPV of the project. So hope you remember the method we are going to discuss here. In the case of proxy beta, we are talking about, we are in manufacturing business. We are entering into software development business. We are entering into new business. We don't have past data. So we will make use of the past data for which there is data available, for existing firms for which data available, the competitor entity. That's what I mean by pure play firms. Pure play firm means they are only into this sector. They are not mixed sectors. So their company will represent only this sector, nothing else. But what happens is their debt equity ratio will be different. From their levered beta will compute unlevered beta. Many firms are there, in this case 4 firms, so we'll compute 4 unlevered betas for 4 firms. Then we take an average, we get the industry beta. Average unlevered beta which are applicable for that industry, that business only, pure business risk. Then you apply the debt equity ratio of the entity, that is going to be levered beta applicable for this project. From the levered beta you compute cost of equity as per CAPM. Now cost of equity and cost of debt, do a weighted average, you get WACC. That's what they're asking, WACC, weighted average cost of capital. Hope you got the overall process. Now let's calculate. First, unlevered beta of pure play firm, so we get industry beta representing pure business risk, no filtration with debt equity ratio part. Okay, so let's use this formula. Hope you remember. I'll write once more. Levered beta is given by unlevered beta into 1 plus debt by equity into 1 minus T, and unlevered beta means this part will be divided, therefore it will be levered beta divided by 1 plus debt by equity into 1 minus t. And keep it in mind, this has a basic assumption that debt beta is 0. That basic assumption is there. Okay, very good. Then you calculate for individual sectors, individual company, pure play firms. Levered beta is given. Their beta is levered beta only 1.1, debt equity ratio 0.3, and tax rate 1 minus tax rate. Tax rate is 0.35. So 1 minus t is 0.65. Like this, you calculate. This should get you 0.921. 3 decimals I am taking. That's what institute has taken. You can take 2 also, 4 also, no issues. But you do for other 3 firms. When debt beta will be more than 0, for exam purpose, whenever they are given in the problem. Practically, what is the impact when the debt beta will be 0? Where the debt instrument structure such a way that they also carry some amount of risk. It is possible they also carry some amount of risk, even practical life, because there's always a risk of default. So being an investor in bonds, you have some risk always. You can't say my investment in bonds are risk free. Some risk are there. So that way beta of the debt can be given, but only when they are given in the problem we will take it for exam purpose. Why are we applying 1 minus t for the entire debt? Because this is the value of debt. I know you are thinking interest is only for 1 year, but we are not taking the value of debt only for 1 year. We are taking the value of interest, and value of interest means what? One debt only. Let me give an example how the value of tax benefit will ultimately come to the value on the debt itself. Let me give an example. Suppose debt amount is 50 crores and interest rate is 10%. Tax rate is 30%. Now every year, what is the interest expense? Interest expense going to be 50 into 10%, 5 crores. Now every year, what is going to be the tax benefit? 5 crores into 30%, which is 1.5 crores. This is the tax benefit for 1 year. 1 year. So what is the value of tax benefit? Present value of future cash flows. In general, we assume the perpetual cash flow. Perpetuity, present value of perpetuity, cash flow divided by required rate of return. So 1.5 crores divided by rate of return. What is the required rate of return? Cost of debt after tax. 10% is the rate of interest, but we need after tax because 1.5 is after tax. So 1.5 into 1 minus 0.3. So what do we get? We get 7. Right? Yeah. So 1.5 crores divided by 7%. How much we get? 1.5 crores divided by 7%. Uh, 21.43 is it? Second, what is happening? Or if I just divide by 10%, I'll get, okay, sorry, don't divide by 7, just divide by 10%, I'll tell you. Just divide by 10%, let's see what you get. Just divide by 10%. I'll tell you why later. Just divide by 10%. 1.5 crores, divide by 10, you get 15. Okay, now what is the value of debt? Is 50. And what is the value of this tax benefit? We get 15 crores. So what is the net debt? Which is nothing but 35, and that's what we are doing here. Debt into 1 minus t. So much big calculation we did, but you don't worry about that. The logic is interest is for a year, and we are getting the value of debt, present value, which means the tax benefit for future years should be considered today, which means as good as applying it on the value of debt, because interest is also rate of interest applied on the amount of debt. So that's why we are doing 1 minus t in a simple concept. So wherever debt comes, simply do 1 minus t. That's a simple concept. Okay. Similarly, you do for the other ones. Okay. So see if you are able to get these numbers for the other ones. I've taken 3 decimals just like institute. You can take 2 or 4, that's fine. So 0.921, 0.774, 0.774, 0.837. Then we'll take an average, simple average. Practically, we can take a weighted average also, because some company might be heavyweight. They will have more market cap. They will be more dominant. So they can be given higher weights. Depends on maybe market cap, practically. But for exam purpose, simple average is sufficient. Okay, hopefully you got it. Then once we get the average, now we are going to do a second stage, that is converting from unlevered to levered by applying your company debt equity ratio. Unlevered beta 0.827, 1 minus tax rate, that is 0.65, debt equity ratio 0.27 given for this firm, 0.27. Okay, once we get the levered beta, we can calculate the cost of equity. Levered beta 0.97, RF is given in the problem already 12, RM is given in the problem 18, so 12 plus 0.97 into 12 minus 18. You should get 17.8. Okay, so cost of equity we have done. Now we have to do cost of debts. Cost of debt, they said before tax 14%. So cost of equity we have done. Cost of debt, let's calculate. Rate of interest, that is 14% into 1 minus tax rate into 1 minus 0.35, so 0.65. So 14 into 0.65. 13.8. 35. Okay, then WACC, weighted average cost of capital. So 9.1 you get, sorry, 9.1 you get, okay, 9.1. 9.1, yes, 9.1. How did we calculate 0.97? In the calculator. Tax 0.65 into debt equity ratio 0.27, then add 0.827, you get the answer. 0.65 into 0.27 plus 1, then you do into 0.827. That is, from the unlevered beta, we are calculating the levered beta. Unlevered beta is 0.827. That is only business risk. And you have taken a loan, so debt equity ratio is there. So from the unlevered beta, you calculate levered beta. Formula is unlevered beta into 1 plus 1 minus t into debt by equity. Basically, what is the logic behind this one? I'll tell you once more. This unlevered beta represents business risk. Now, equity shareholder will assume two types of risk. One, the risk what was supposed to be borne by them because of the business, and other, what was supposed to be borne by the debt is also borne by the equity people. Two risk. That's what here you are telling. This one represent your risk. Your risk of business. This debt by equity means what was supposed to be borne by debt, but that is also borne by equity shareholders. So this one represents here the business risk relevant for beta, and this debt by equity represents impact of debt, impact of financial risk. So this levered beta, unlevered beta represent business risk. Debt by equity, what we are multiplying, represents financial risk. That's the two components. One is business risk. This debt by equity represents financial risk. I hope the formula logically also you remember, not just the formula, not just derivation, but the logical aspect also. Okay, so WACC is calculated by cost of debt into weight of debt plus cost of equity into weight of equity. Cost of debt we got 9.1 into its weight. Can you tell me how much is its weight? Weight of debt. What is the weight of debt for this project, for this company? It is not 0.27. 0.27 is debt equity ratio. So when I say 0.27, here also we did debt to 0.27 for every 1 rupee equity. So we should do 0.27 divided by 1 plus 0.27. So 1.27. If they told you debt ratio, you can use that as debt equity ratio. Similarly, for equity, it is cost of equity 17.82 and equity is 1 by 1.27. Don't do 1 minus 0.27. That is debt ratio and equity ratio. But here they have given debt to equity. Debt to equity means you should do debt by debt plus equity. Equity by debt plus equity. So that one, when you simplify, see if you are able to get around 15.99%. Approximately 16% you can say. $9.6 is it? Okay. Okay, 15.96. 97 you can say. Okay, so this is the application of levered beta, unlevered beta, proxy beta, everything in one problem. Okay, so next one. Mr. X owns a portfolio with the following characteristics: security A, security B, risk-free security, factor 1 sensitivity, factor 2 sensitivity. What do you understand by factor 1 sensitivity, factor 2 sensitivity? Sensitivity is a term we use for which measure? Sensitivity means it is beta. So beta for factor 1, beta for factor 2, and so on. 2 factors in the problem. It is assumed that the security returns are generated by 2-factor model. So 2-factor, don't think about some model about this arbitrage pricing theory. 2 factors, factor 1, factor 2. If Mr. X has 1 lakh to invest and sells short 50,000 of security B and purchases 1,50,000 security A, what is the sensitivity of Mr. X portfolio to the 2 factors? Please observe. If he sells shorts, shorting the concept you don't know yet as of now. I will discuss during derivative stages, but as of now, please remember, like borrowing in shares. That is borrowing in shares. So you borrow the share, sells the money, get the amount. You don't borrow the money directly. You borrow the shares. And that shares you sell in the market and you get the money out of it. You get the money only, but slightly different process. How can you borrow in shares? Impact wise, why will you do it? What is the process of doing it? We discuss all these things when we go to derivative chapter. So as of now, just remember, shorting means borrowing in shares. So he has 1 lakh with his own money. By borrowing, he got 50,000 and together he has 1,50,000 which he invested in buying in security A. If Mr. X borrows 1 lakh at the risk-free rate and invests the amount he borrows along with the original amount of 1 lakh in security A and B in the same proportion as described in part 1, what is the sensitivity of the portfolio to the above factors? What is the portfolio expect return premium in 2 above? What is the expect return premium for factor 2? Okay, let's calculate all these things. First, what is portfolio to the what is sensitivity of the portfolio to the 2 factors? Please tell me how many portfolio beta we have to calculate. We have security A, security B, and we are mixing it in portfolio. So how many you have to calculate for portfolio? 2 factors for factor 1 and for factor 2. But process is simple. We have to multiply beta with respective weights. So first we'll compute the weights. Okay. So for first part of the question, computation of portfolio beta. Portfolio beta. For 2 factors. So we get 2 answers. For 2 factors. For factor 1, factor 2. First we'll compute the weights. Okay, so for weight purpose, simple for tabular calculation, security, amount, weight. Security, we are having A, security B. Security A, I will write 1,50,000. You have invested 1,50,000. In B, you have borrowed the money. So minus 50,000. Borrowing in securities. Sell short. Borrowing in securities. So total 1 lakh. So what's going to be the weights? 1,50,000 divided by 1 lakh, which is 1.5. And minus 50,000 divided by 1 lakh, which is minus 0.5. Minus 0.5 because you're borrowing in securities, but total of the weights should always be 1. Then portfolio beta for factor 1. And then we'll calculate portfolio beta for factor 2. Simple formula only. That is beta 1 weight 1, beta 2 weight 2. Here also same formula. Portfolio beta, beta 1 weight 1 plus beta 2 weight 2. Weighted average. So what are the beta 1, beta 2 for? We are computing for security for factor 1. So look at only factor 1. Factor 1 means only look at first column. Only look at first row, sorry, first row. So betas are 0.8 into the weights and 1.5 into the weights. So 0.8 into 1.5 and 1.5 into minus 0.5. So minus 0.75 you get. So 1.2 minus 0.75. You get 0.45, is it? On simplification. 1.2 minus 0.75. Think 0.45. Okay. Similarly for second one. So second factor. 0.6 and 1.2 we have. So 0.6 multiplied by weight and 1.2 multiplied by weight. So 0.6 into 1.5 and 1.2 into minus 0.5. So 0.9 minus 0.6. I think you get 0.3. 0.30. So you get 0.45 as factor 1 beta for portfolio, 0.3 factor 2 beta for portfolio, 0.45 and 0.3. Okay, hope you got these numbers right. I'll go to second part of the problem. Okay, let's see what is required in second part of the problem. If Mr. X borrows 1 lakh and invests the amounts he borrows along with the original amount in the same proportion. So Mr. X borrowing 1 lakh and investment in same proportion. Now, can you tell me, when you invest 1 lakh in the same proportion in A and B, how much will you invest? In which ratio will you invest? They said in same proportion. So in which ratio and how much will you invest in each stocks? How much in A? How much in B? Earlier you had 1 lakh. Earlier you had 1 lakh. And 1 lakh, how did you invest? Minus 1,50,000 plus 50,000. 1,50,000 and minus 50,000. Now you got 1 more lakh in the same proportion you invest. Means you invest in the ratio of 1.5 is to minus 0.5. Which means invest 1 lakh in the same proportion. So in the ratio of 1 is to minus 0.5. 1 in A, 1 lakh, and minus 0.5 in B. So when you have 1 lakh, you will invest in the ratio, not 1 in 1.5. 1.5 is to minus 0.5. 1.5, yes, not 1. 1.5 minus 0.5, right? We calculate this ratio. 1.5 minus 0.5. This we make use of it. 1.5 is to minus 0.5. So how do we invest? How much in A and how much in B? In A, we invest 1.5. 1.5 into 1 lakh. So we invest 1,50,000 minus 0.5 into 1 lakh. So we basically short 50,000 minus 50,000. So what is your revised weights will be now? Revised weights. Security, amount, weights. Now, security, we are having security A, security B, and we are also having risk-free security now because you are borrowing. Risk-free security you are borrowing. This is the borrowing. This is the borrowing in money, not the borrowing in shares. Now security A, amount, how much amount? We had already invested 1,50,000. So 1,50,000 and 1,50,000. So that is going to be 3 lakh. We had 1 lakh initially and we invested 1,50,000 more. Similarly, B, we had shorted 50,000 and we further short 50,000. So total minus 50 and that becomes minus 1 lakh. And risk-free security you have borrowed, so that's also going to be 1 lakh. So total amount, if you see, it's going to be 1 lakh. You borrowed 1 lakh in money, so that's what I told. Borrowing, risk-free security minus 1 lakh. Weights, how much will you calculate the weights? 3 lakh divided by 1 lakh, which is 3 minus 1 lakh divided by total 1 lakh, because your investment 1 lakh only, that is not change out your own money, that is same, minus 1 and minus 1 lakh by 1 lakh minus 1 and total weight 1. Then portfolio beta, portfolio beta, portfolio beta for factor 1, for factor 1 we look at the factor 1 values, which are 0.8, 1.5, 0, 0.8, 1.5, 0 multiplied by their weights, which we calculated here in this column, into 3 into minus 1 into minus 1. That one anyway 0, so you can ignore that. So 0.8 into 0.3 is a 2.4, or 2.4 minus 1.5, 0.9 you get. Factor 2 beta, okay, what are the factor 2 betas? We have 0.6, 1.2 and 0. 0.6, 1.2, 0. So multiplied by 3, multiplied by minus 1, multiplied by minus 1. So that will give you 0.6. Shorting and investing in borrowed funds will lead to decrease in beta. Yes. Let's see what happens. Okay. Now, is it really decreasing? What do you think what is happening? Previously, we were having how much beta for factor 1? We are having 0.45 and now we are getting 0.9. So previously we were getting 0.3 and now we are getting 0.6. So in both cases, the beta have been increased. Can you think why? What is the reason? What could be the impact, logical explanation for increase in beta? It's not the negative weights. It's because of the borrowing in money. It's because of the borrowing in money, which means earlier you are not borrowed in money. Borrowed in security, you forget. That is not an impact as of now. But when you borrow in money, that means I told you it's always a financial risk. That means previously it was unlevered beta because you are not borrowing in money, and now you are having borrowing in money. So when you borrow money, beta will increase. I told you, we discussed during the basic stage also, if you bring in risk-free investment out of your money, beta will reduce. On the other hand, if you borrow money and invest, your risk will increase, beta will increase. Beta levered versus unlevered beta. Let's quickly do a comparison of that. So in part 1, what we had was no borrowing in money, no borrowing in money. Therefore, it was unlevered beta. In the second, what we did, we had borrowing in money. Therefore, it is levered beta because you have taken financial risk. That's what APT theorem says. So if you want to bring new security, if you want to manage the risk, instead of borrowing money, you can do shorting in security. That will reduce the risk. Anyway, those things will not worry too much. Let's compare it here. Show the last slide. Not taken down still. 0.9, 0.6. Okay, let me compare it now here. For the factor 1, I'll do first, then let me do for factor 2. Remember the formula? From the unlevered beta, how do you calculate the levered beta? Or levered beta, how do you calculate? Levered beta is given by unlevered beta into 1 plus debt by equity into 1 minus t. In this problem, no tax rate. So 1 minus t you ignore. So for factor 1, what was the unlevered beta we had for the factor 1? Previously we had beta of 0.45. Factor 1, 0.45 into 1 plus. Can you tell me what is the amount you borrowed in the second situation? In the sense, what is debt equity ratio? Can you tell me debt equity ratio, debt by equity in part 2, because you borrowed 1 lakh. How much is going to be your debt equity ratio, debt to equity? How much is debt? How much is equity? Debt to equity ratio 2:3, 0. I'm asking about in part 2, 0. I'm discussing so much because there is borrowing in part 2. I am talking about the amount of money borrowed, 1 lakh. You can't say no debt equity ratio. You borrowed 1 lakh. One by 3, 3:2. See how much different you are telling. One simple ratio, debt equity ratio. Answer is 1:1. Shorting is not borrowing. I'm only talking about borrowing in money. I'm specifically writing it here. I don't know what you people read. Borrowing in money. Borrowing in money. I only talking about borrowing in money as the impact on levered beta and levered beta. I'm not talking about borrowing in security at all. So when you have, in this case, how much money you had? In the first case, you had 1 lakh. Now in the second case, how much money you have? 1 lakh only. Your money is 1 lakh. That's why you see the total. In the first part of the question, you had 1 lakh, no borrowing in money. So debt equity ratio is 0:1. 0 debt for 1 lakh amount. In the second case, your money is still 1 lakh. Your money is still 1 lakh. That is not getting changed. Your own money is 1 lakh and you borrowed 1 lakh. Borrowing in shares, you forget about it. Not required. So borrowing in money is 1 lakh. Your own money, even in part 2, did not increase. That is 1 lakh only. So ratio is 1:1. So 1/1. So what do you get? 0.45 into 1 plus 2. That is 1 plus 1. That is 2. So 0.5 into 2. That becomes 0.90. I think that's what we got here, 0.9. Second case, how do you write levered beta for factor 2? It was 0.3 earlier into 1 plus 1/1. Debt equity ratio is same, 1:1. So here you get 0.60. That's what you got it here, 0.6. The impact of debt. So basically the impact of borrowing or impact of financial risk. Impact of borrowing money or the impact of financial risk. Okay, this is just for your reference, conceptual discussion, not required for exam. For exam, this what we call compute 0.9, 0.6, that much is sufficient. Okay, 2 more parts to the questions are there. Let's discuss that. Okay, what else they asked? What is the portfolio expected premium in 2 above? In 2, what is the portfolio expected return premium? Expected return premium means over and above risk-free rate. So we'll compute the expected return, we subtract the risk-free rate. So third part of the question, premium for portfolio. Okay, so expected return. Of portfolio, that is RP. 3 securities you are investing, because they are asking in 2, premium for fact portfolio in 2, right? In 2. So we will do weight in security A into return of security A plus weight in security B into return of security B plus weight in risk-free security into return of risk-free security. So weight we got it as 3 minus 1 minus 1. That is the weight we calculated here, 3 minus 1 minus 1. 3 minus 1 minus 1. What are the returns we have? 15, 20, 10. 15, 20, 10. So 45 minus 20 minus 10. I think 15. Premium is the portfolio return minus risk-free rate. portfolio return 15, risk-free rate is 10, so premium is 5%. Over and above risk-free rate, 5%. Okay. Hope it is done. Last part of the question. Okay, so what they're asking, last part of the question, what is the expected return premium for factor 2? Only for factor 2, not for the portfolio. Premium for factor 2. So basically we have to calculate lambda 2, because lambda 2 means factor 2 premium. So we will use security A and security B. So what is the formula under APT formula? Return of a security is given by lambda 0 risk-free security plus lambda 1 for factor 1, beta 1 for factor 1 plus lambda 2 for factor 2, beta 2 for factor 2. Let's use this formula for security A and security B and we'll try to simplify. So for security A, what is return expected for security A? Return expected for security A is 15%, and sensitive factor 1 factor 2 is 0.8, 0.6, and risk-free security is 10%. So 15 expected return, 10 that is risk-free return, and lambda 1 we don't know, beta 1 0.8 for security A, and lambda 2 we don't know. For security A 0.8, 0.6, no, what's the confusion? We are calculating for security A. For security A, beta 1 is 0.8, beta 2 is 0.6. 0.8 and 0.6. Similarly, we do for security B also. For security B, it is 20% and beta 1, beta 2 are 1.5, 1.2. 20% and beta 1, beta 2 1.5, 1. Now we are not calculating anything for the portfolio here. We are calculating for the the pure factor premium based on the respective securities. So if you look at this equation, lambda 1, lambda 2 is unknown. So we can solve this by solving simultaneous equations. That's all is required. So solve it by simultaneous equations. So 15 minus 10, that becomes 5. So 0.8 lambda 1 plus 0.6 lambda 2 equals to 15 minus 10, which is 5. Then 1.5 lambda 1 plus 1.2 lambda 2 equals 20 minus 10 equal to 10. So solve by simultaneous equations. Okay, I hope you know how to calculate the simultaneous equations. We'll multiply it by respective coefficients to make it same. So here we have 0.8, 1.5. So multiplied by 1.5 multiplied by 0.8. So 0.8 into 1.5 becomes 1.2 lambda 1, 0.6 into 1.5, 0.9 lambda 2, 5 into 1.5, 7.5, 0.8 into 1.5, 1.5 lambda 1, 1.2 into 0.8, 0.96 lambda 2. 10 into 0.8, that is 8. Now coefficients are same, so subtract the equations. Minus, so this is 1.5 to 0.8, 1.2 you get, sorry, 1.2. So this will get cancelled. 0.9 minus 0.96 minus 0.06 lambda 2 is 7.5 minus 0.8, 7.5 minus 8 minus 0.5. So minus minus gets cancelled basically. So lambda 2 is minus 0.5 divided by minus 0.06. Then you get 8.33 lambda 2. So factor premium for 2. Factor 2. You can also do for factor 1. You can simply substitute. Let's quickly do for our reference. Substitute in this equation. 0.8 lambda 1 plus 0.6 into 8.33 lambda 2. That's what we calculated. Equals 5. So 0.8 lambda 1 plus 0.6 into 8.33. You get 4.98, let's say 5. So 0.8 lambda 1 equals 5 minus 5. So 0.8 lambda 1 is 0. Therefore 0.8 if you divide, it will be same. So lambda 1 equals 0. They have not asked for some 1, but if they asked, the answer would have been 0. So no impact actually. Everything is because of the factor 2 only. Okay, so this is one problem which you can expect in exam, maybe slightly complex. So quite a few things are there here. In the earlier question, expected value minus expect return, not GNP expected minus actual value. It's not GNP expected. The difference between the expected return based on GNP minus actual return based on GNP. It's a return percentage. Return differential, not the value differential. Okay. Okay, so hope you got this question, Mr. Abhishek, that problem. This is a master problem in portfolio management. 90% of the portfolio management formulas can be found in one place. These are the problems you should do it day before exams. Everything in one problem. Let's see to what extent we can solve it. Mr. Abhishek is interested in investing rupees 2 lakh, for which he is considering the following 3 alternatives. Investing rupees 2 lakh in mutual fund X, investing rupees 2 lakh in mutual fund Y, investing rupees 1,20,000 in X and Y. 1,20,000 in X, 80,000 in Y. Average annual returns earned by mutual fund X and Y is 15 and 14 respectively. Risk-free rate of return is 10% and market rate of return is 12%. Covariance of returns of X and Y and market portfolio are given below. You are required to calculate variance from XY market return, portfolio return, portfolio beta, portfolio variance, portfolio standard deviation, expected return, systematic risk, unsystematic risk, Sharpe ratio, trainer ratio, alpha of X, Y, portfolio mix. Everything. What else you should write in the exam? What else you want? Everything is there. Fine. Again, few small tricks which people get confused. Let's see if we can address it first. The first thing where mutual people will fall for it in exam by looking at the word mutual funds. They look at the question paper in exam. Oh, mutual fund is there. I know mutual fund. Mutual fund is EG chapter. So you tick it also. This problem I will do it. When you start reading the problem, after some point in time, you understand. Oh, this is not the mutual fund problem. This is portfolio everywhere. So, gone. You thought you get some 8-10 marks. This is going to be a challenging point in exams. Okay, fine. So, the word mutual fund is always subject to market risk. Read the question carefully before in the exam. Before concluding, it is a mutual fund problem. It might be a portfolio problem. Second point. You are having three choices. Invest in X, invest in Y, or invest in mix. 1,20,000, 80,000. Okay, look at the heading they have given. MFX, MFY, mix. MFX is relating to option 1 here. MFY is relating to option 2 here. Mix is relating to option 3 here. Please tell me, is my interpretation correct? The first heading goes to first part of the problem. Second heading, second Roman number there. Third heading, third, investing in both. Is my interpretation correct here? Is my understanding correct here? Is my understanding correct? No, my understanding is not correct. MFX for first, yes, that is right. MFX for Y, second one, that is right. But third one is not for mix. Read the question. This is market portfolio mix. This is not mix of 1,20,000, 80,000. This is market. Like market return, secured return, like that we give. No. So the third column represents market. They confuse you. They mislead you by giving the word mix. First MFX, second MFY, then you mix both. Portfolio you get. That mix is different from this mix. This third part of the problem is a mixture, that is where portfolio you get. This is not your portfolio. This mix is market portfolio. In simple words, M. I hope you got it. Where you go wrong. And one more point. This is just to mix. This is M. Are they same or different? Look at this. MFX, MFX. Same. MFY, MFY. Same. But here they've used the word mix. Here use the word M. Are they same or something different? Are they trying to indicate something? Nothing. Just like MFX, MFX are same. MFY, MFI are same. This mix and M are same. Misleading you by giving different titles, headings. It is same. What is that? That is a market portfolio mix. Whether you call mix, whether you call M or you call MP, whatever it is, that is representing market portfolio. That's how they mislead in examination. Okay, now let's come to the first part of the question. Very, very interesting. Variance of return from XY market return. What is variance? Sigma security square, standard deviation square. That is variance. You know that is a formula for variance. How do we calculate variance? We know, sir, summation s minus s bar or x minus x bar divided by n square root. If I do a square, I get variance. Where is x values? Where is x minus x bar values? Sir, x values are here. X values, no. These are not x values. These are covariance returns. Covariance returns. What is that? I'll come in a second. Then how do we calculate? Now we know x bar they have given 15, y bar they have given 14. You are right. Where is x values? This is covariance table. X bar is given. X value is only not given. Have a flashback. How we used to calculate x minus x bar? Year 1, year 2, year 3. Add all. Divide by 3. We get x bar. Then year 1 x minus x bar, x minus x bar whole square. Like that we used to do. Yearly data not given. Then how are we calculating? Actually, in this part, we are not calculating. We have to identify. There is a beautiful interpretation. Listen to me carefully. Very good problem. That's what I said at the beginning. Okay, let's understand. What is this covariance matrix? Covariance. Covariance means, you know, it's always between two securities. What is variance? Sigma square. That is, you compare with yourself with respect to your average, how you behave. Variance, variation. Covariance means between two securities always, right? So what do you understand by 4.3? 4.3 is the covariance between mutual fund X and mutual fund Y. Let's not call it as mutual fund X and Y. Let's call it security X and Y. So between the two securities X and Y, the covariance, or I'd say covariance between X and Y is 4.3. Similarly, between X and market, covariance between X and market is 3.3. Is covariance between X and Y is same as Y and X? Of course, X, Y, Y, X both are same. Look at that. Covariance between X and Y we told 4.3. You observe Y and X. Covariance between Y and X is also 4.3. X and Y is 4.3 and Y and X is also 4.3. X and market is 3.37. Market and X is also 3.37. Again, their repetition just to confuse you. Same thing. Y with market is Y with market is 2.8 and market with Y is also 2.8. Okay, now here comes the important thing. Now please tell me, what do you understand this? I'll tell you, simply try to respond. 4.3 is covariance between X and Y. Covariance between X and Y is 4.3 given. Very good. Now please tell me, how do I write down 4.8? It is covariance between what? 4.3 is between X and Y. So we wrote covariance X comma Y. How do we write 4.8? What is in row heading? What is in column heading? Covariance between which two variables? Covariance between X and X only, right? Row heading also X, column heading also X. So we write it like this. Covariance between X and X is 4.8. What is covariance between X and X? That is nothing but variance of X. How, sir? What is the formula for covariance? X minus X bar into Y minus Y bar. If I take out Y minus Y bar, there also if I put X minus X bar, what will happen? Summation X minus X bar into X minus X bar, which is nothing but X minus X bar whole square, which is nothing but variance. So this table, let's rewrite in slightly different format now. Okay, so the covariance matrix what we have, let's try to write in our comfortable manner. Covariance matrix. Let's try to write in the comfortable manner what they have given. Okay, first between X and X, covariance between X and X The row heading, column heading you can take x comma x. That is 4.8. And covariance between yourself is nothing but variance of x. Variance of x. This is variance of x. Then covariance between, what is next variable? X and y, x comma y. That is 4.3. Okay, that is not required anyway. Then covariance between x and market. X and market 3.37. Then covariance between, don't write y and x again. You get 4.3 only. I told you x comma y, y comma x, so both are same. So don't write x, y comma x again. Let's go further. Covariance between y comma y. So y row heading, y column heading 4.25. That is nothing but variance of y square. Variance of y. Then y and m, covariance of y and market. So y is row heading, market mix heading 2.8. Then covariance between market and x, don't do it. M comma x we already done. Don't do covariance between market and y comma we already done. Covariance between m comma m. That is last one, 3.1. And that is nothing but market variance. Variance of market. Variance of market. So if you can't identify this itself in the first part of the problem, rest of the questions you cannot answer at all. Okay, hope you got first part of the problem. Shall I go further? Okay, second part. Portfolio return, beta, portfolio variance, portfolio standard deviation. So this portfolio return, portfolio beta, standard deviation is only for third part of this question, you understand? For X and Y are independent securities. We are mixing 1,20,000, 80,000. So we are only talking about that third part of the question. For the portfolio, they are asking portfolio return, portfolio beta, portfolio variance, and portfolio standard deviation. So let's calculate. For the portfolio, what and all we have to calculate? Portfolio return, I'll say RP. Hope you understand the short form. Portfolio return we have to calculate. Then beta of portfolio we have to calculate. Then standard deviation of portfolio. Variance. Once I compute standard deviation variance, if I take a square root, I get the standard deviation of the portfolio. Okay. First of all, to compute the portfolio, I need weights. So what is weight in X? I think I'm investing 1,20,000 out of 2 lakh. So that's going to be 0.6. And weight in Y, I think 80,000 out of 2 lakh, which is 0.4. Is it correct? Yeah, 0.6, 0.4. Okay. Portfolio return, you know weighted average. That is weight in security X, return of security X, plus weight in security Y, return of security Y. Weighted average, easy to calculate. So 0.6 multiplied by, what is the Average returns, they have given the average return 15 and 14. 15 plus 0.4 into 14. 14.6. Okay. Now beta of portfolio, similar format. Weight in x multiplied by beta of x plus weight in y multiplied by beta of y. Oh, beta we don't know. Let's calculate beta first then. I'll rewrite in the previous slide. So beta, let's calculate. You know the formula for beta. Beta between security and X and market, let's say. What is beta formula? Covariance divided by market variance. Hope you know that. Covariance by market variance. So for the beta between X and M, covariance X and M, we have got 3.37. By market variance, we have got 3.1. So 3.37 by 3.1, 1.087. Just 1 second. 1.087. Okay, then beta between y and m, same formula, covariance by market variance. Between y and m, covariance is 2.8. 2.8 divided by market variance 3.1. These are already variances, so no need to square them. 2.8 by 3.1, 0.903. I've taken 3 decimals. You can take 2 also, you can take 4 also, no problem. So let's go further. Hope you have taken down till here. 1.087, 0.903. Okay. So 1.087 0.903. Its weight 0.6 plus 0.4. So 0.6 to 1.087 and plus 0.4 into 0.903 and plus MRC. 1.013 portfolio beta 1.013. Okay, portfolio variance. Portfolio variance, I hope you know the formula, A plus B all square formula. That is using Sharpe index. Wx square beta square plus Wy square beta, not beta, sorry, standard deviation. Standard deviation. This is Markowitz, using Markowitz. You can also do it using Sharpe index. I'll show it later. You can also do it using Sharpe index. I'll do it later. Sigma y plus 2 Wx Wy. Instead of having sigma x, sigma y and r, I can replace it by covariance between x and y. Hope you know this. I was supposed to multiply by sigma x, sigma y by r. Instead of that, I can replace it by covariance between x and y. Hope you're aware of it. So weight is 0.6 and 0.4. Standard deviations are, variances. Variances of x and y already know, which is 4.8 and 4.25. Okay. So this is 4.8, 4.25. That you don't square it. That's already a variance. That's already a square. Weights only you square it. 0.6 square and 0.4 square. plus 2 into WXWY 0.6 into 0.4 and the covariance between X and Y. Covariance between X and Y, this one. Covariance between X and Y, 4.3. So if I calculate, what do I get? 0.6 square, 0.6 into 0.6 into 4.8 and plus 0.4 into 0.4 into 4.25 and plus 2 into 0.6 into 0.4 into 4.3 and plus MRC. 4.472, I think. Okay. Square root of this, square root of 4.472, 2.115 if I take 3 decimals. So this is done using Markowitz. You can also do it using Sharp Index. I'll show it to you later. Okay. What else required? Expected return, systematic risk, unsystematic risk, Sharpe ratio, trainer ratio, and alpha for X, for Y, market portfolio mix. Okay. I think this will take little bit more time, second part and third part, and I don't want to do it in a hurry, and I don't want to mix and match that part here, part there. Let me do one thing. Let's do that in the next session. Fine. Second part and third part. You can try it, of course. Let's do it in the next session. So in the previous session, we were doing this master problem. We just done halfway through. The first two part of the problem we had done. The second and third part, we have to do it now. I'm getting one question. Let me read and answer it for you. I'm able to understand explanation, but when you try to do problem, I'm not able to do it. Should I spend more time on SFM? What approach should I adopt? Obviously, simple answer is practice is definitely the key. And second most important point is when you doing things on your own, where you are getting stuck, try to identify which area you are getting stuck. you have to define the problem before you solve the problem. In the sense, are you, for example, if it's a portfolio management chapter, are you struggling to define the column headings, or are you not able to apply the formulas, or are you not able to mathematically simplify it? So you have to define the problem, see where you're getting stuck, and then you'll be able to do the problems easily. And of course, if you do more number of problems, you will definitely get more practice. Okay, so having said that, let us continue with the third part of the question. Expect return, systematic risk and unsystematic risk of what? Of X, of Y, and of West, and of the portfolio. Expected return. Expect return means obviously we'll go for CAPM return. For expect return, we require RF, we require RM available, RM available, and we require beta. Beta is also we have calculated in the second part of the question. So we have calculated beta of security X in first part of the problem we have calculated. While coming to second part, beta of X we have calculated, beta of Y we have calculated, and beta of portfolio also we have calculated. So we'll be able to calculate expected return. So let's calculate in third part of the question, expected return. Using CAPM. So we require RF, then RM minus RF multiplied by beta. We'll do for security X, that is MFX. We'll do for security Y, MFY, and we'll do for portfolio. Okay, so 10 and 12 are RM and RF. So 10, 12 minus 10. Same thing for others. Beta we calculated 1.087, 0.903. And beta of portfolio 1.013. So this will give us the expected returns. You can also say ER, expected return, or cost of equity based on CAPM. So 12 minus 10, that is 2 into 1.087 plus 10, 12.174, 2 into 0.903, 11.806. Hope you understand why this number is more than 12, because beta was more than 1. And second one was less than 12, less than market return, because it is beta less than 1. And third one in between the two, that is 2 into 1.013 plus 10, 12.026. Okay. You can also calculate the portfolio based on average return, So if I, for portfolio, one method is this. Alternatively, one more method, you can also do by the weighted average. That is, X has got 12.174 and its weight. What was the weight? Hope you remember in the previous session we discussed 0.6 and 0.4. So 12.174 into 0.6. plus 11.806 into 0.4, which will give you 12.026. You can see that both way, either using CAPM directly or using a weighted average of the CAPM returns will give you the same answer. Okay, they've asked us expected return, we have done. They've also asked us the systematic risk of portfolio and unsystematic risk of portfolio. Systematic risk of portfolio, it's very simple to calculate. But unsystematic risk of portfolio, you can do it in two ways. One, using Sharpe approach. What is Sharpe approach? You compute the unsystematic risk of each security, then you add all of them. And another approach is as a balancing figure, that is total risk minus uh, the systematic risk of as per Markowitz, that balancing figure you can calculate. So let me show you both the ways. I hope you have done till here. Okay, so systematic risk of portfolio. Or I can write it there itself. I have some more space because that will be same under both cases. Systematic risk of portfolio. Okay, hope you remember the process. From the market to reach the security, we take the help of beta. When I'm moving from a market to security, I take the help of beta of security. If I'm moving from a market to portfolio, I will select beta of portfolio. So what is market risk? Market risk is going to be sigma m square. That is market risk, market variance. Then multiplied by, we need a portfolio risk. So from the market to come to portfolio, we use beta of portfolio square. So market variance, we have identified market variance. That is this one, covariance between market and market, 3.1. And beta of portfolio, I think we just calculated earlier, 1.013. 1.013. Okay, now market variance is already square. I don't have to square it. But beta of portfolio, I need to square it. Market variance is already square, so don't touch that. But beta of portfolio must be squared. So 3.1 into 1.013 into 1.013. You have 3.18. Okay, next. Unsystematic risk of portfolio using or based on Markowitz. Based on Markowitz. This is basically a balancing figure approach. not a weighted average approach. Balancing figure approach. So what we are doing now? Unsystematic risk, that is sigma EP. E used for errors, that is for unsystematic risk square, is calculated as balancing figure, that is total risk of portfolio, that is using again Markowitz, minus systematic risk. Total risk of portfolio, that is sigma p square, what we calculated, minus systematic risk, what we just calculated, that is market variance multiplied by beta of portfolio square. We just calculated now systematic risk. So portfolio, what we calculated, let's observe. I think we had got 4.472 using Markowitz. 4.472 minus systematic risk, what we just calculated now, 3.18. So balancing figure is what you get, unsystematic risk, 1.29. This is the balancing figure approach. You can present like this, institute like this method, full-fledged problems, more convenient. Okay, hope you have taken down. Now let's calculate unsystematic risk using Sharpe method. Okay. Unsystematic risk. Sharpe method. Okay. So what does this method will tell you? We have to first of all calculate unsystematic risk for each security separately. Then you can combine it. So we are going to do in a columnar approach. If you are comfortable, we can write horizontal approach that you can do in exam. I'm still comfortable with preparing charts. So we have mutual fund X, that is for security X. Then mutual fund Y, that is for security Y. So we are going to have total variance sigma X square, and here also total variance sigma Y square. Okay, let me complete this. This will be divided into two parts, that is systematic and unsystematic, and this also I'll just write the same chart. Systematic and unsystematic. Okay, now systematic risk is we start with market variance multiplied by, how do we move from market to security? We take the help of beta. So we do beta of security X square. And systematic risk is balancing figure. So what is the standard deviation of the security X, variance of the security X? We have calculated, we have identified actually. Starting point, variance of X 4.8. Variance of X is 4.8. Now market variance into beta. Market variance was 3.1. From the first part of the problem you can identify 3.1. And beta of X 1.087. So 3.1 into 1.087. 0.087. Of course, market variance is already square, so 3.1 square don't do it, but beta square we should do it. So 1.087 square. 3.1 into 1.087 into 1.087. 3.662, 3.663. Okay, unsystematic risk is a balancing figure. So 4.8 minus, okay, the unsystematic risk is actually we rate it as sigma E of x square. E for error, x for security x, and square because it's variance. So 4.8 minus 3.663. 1.137. This is sigma Ex square, unsystematic risk. Same approach we do for y as well. Market variance multiplied by, from the market to come to security, we take the help of beta. Beta of security y square. Unsystematic risk is sigma E y square. So market variance is 3.1 and beta is 0.903. 0.903. The 0.903 square. 3.1 into 0.903 into 0.903, 2.528. And market, okay, so what is security Y variance from the first part of the problem? It is 4.25. So 4.25 minus 2.528, that gives 1.722. Okay, now of the portfolio, now relating to the portfolio, systematic, unsystematic. Systematic we already calculated. We know the formula also. Portfolio variance multiplied, market variance multiplied by beta of portfolio. The same formula we used, we already calculated. Let me write the amounts. Market variance by beta square 3.18, that we already calculated. So I'll just write it. So you don't have to write that also. I'm writing for your reference. Unsystematic risk, what we are going to do? We will take security X unsystematic variance, security Y unsystematic variance, and we combine the both using weighted average. And the weight is going to be a square, right? So this is going to be sigma Ex square multiplied by its weight, that is weight of x square, plus similarly for unsystematic risk of y, sigma Ey square multiplied by weight of y square. That is, we have 1.137, that need not be squared, that is already square, its weight must be squared into 0.6 square, plus sigma Ey square, that is 1.722 into wy square, that is 0.4 square. 1.722 need not be squared, that is already square, but its weight 0.4 must be squared. So we can make use of a m plus function, 1.137 into 0.6 into 0.6 equal to m plus 1.722 into 0.4 into 0.4 equal to m plus MRC. You get 0.684. 0.685. Okay. 0.685. Okay, 0.685. Okay, so this is what is unsystematic risk using Sharpe methods. That's what we are heading have given, systematic risk using Sharpe method. In fact, even portfolio risk can be calculated using Sharpe method. How do I do that? This systematic and systematic must be totaled. So if you just do the total, how much you get? 3.18 plus 0.685, 3.865. 3.865, right? So this is the total risk of the portfolio using Sharpe method. So I'll just go back to the previous slide for a second. You remember this what you written, second part of the problem? I have written also this using Markowitz. So we can also write down this sigma p square, what we just calculated now, that is 3.865, 3.865, that is portfolio risk using Sharpe index, using Sharpe index. And if I take a square root, I get the portfolio standard deviation, square root of this, square root of 3.865, 1.966. So in the exam, you don't have to do both. Either you can do it using Markowitz or you can show it using Sharpe. You don't have to show the both the methods. In the examination point of view, if they're not specified both, I would recommend go with Markowitz method because that is faster. Rather than preparing these two charts, you can avoid preparing these charts if they're not specifically asked for Sharpe methods. We don't require this for x1 chart, for y1 chart, and combined we prepared one more. That's not required. Anyway, so on systematic risk, using balancing for approach, we got 1.292, and using Sharpe approach, we got 0.685. Conceptually, they tell you same thing, but mathematically, they differ in their calculations. So we have done the third part of the question, expected return, systematic risk, unsystematic risk. In fact, we have calculated all these three for X, for Y, and also for the portfolio. Okay, I hope it is done. I'll go for fourth part of the question. So this we have done. Ratios, Sharpe ratio, trainer ratio, alpha, for X, for Y, for portfolio mix. Actually, this ratio is part of mutual fund chapter if you see study material questions. But I've included here itself because I think these are more relevant for portfolio chapter. But it will again come in mutual fund chapter also in some problems. So you might see some duplications. Well, anyway, three ratios only will come. Now, can you tell me first of all, how many ratios I have to calculate for fourth part of the problem? How many? Count. They asked Sharpe ratio, trainer ratio, alpha. So how many ratios I have to calculate? Total. Count. Okay, we have to calculate. I don't know why people are to type a number. It takes so much from you. I think I should pay you to respond something. Honestly disappointing. Okay, let us calculate. Why should I ask you the question? Why should I make you to think and all? Let us just solve the problem. And why worry about interpretations and all? Let's just calculate. Okay, so we are having ratios. Let's calculate. Sharp ratio. Sharp ratio formula is given by, or let's calculate in a columnar manner. Ratios. Sharp ratio. Trainer ratio. And Jensen's alpha. We have to calculate for mutual fund X, that is security X, mutual fund Y, and also for portfolio of X and Y. So formula going to be Sharp ratio is whatever the security return or portfolio return of portfolio minus risk-free rate divided by standard deviation of portfolio. That is Sharp ratio. Trainer ratio RP minus RF divided by beta of portfolio. Jensen's alpha is whatever return of portfolio minus ER. ER basically we can say CAPM return. I'll just say minus CAPM return. So what is Jensen's alpha? If you remember in the graph, we write the security market line. If you get more return than that on the security market line is your required rate of return, cost of equity. But if you get more than that, that means we say it is undervalued, good to buy, and that is what is Jensen's alpha. Okay, I am telling all these things. Let's calculate sufficient. Okay, so return of portfolio, where is that given from the question? Risk-free rate is 10. Portfolio return, average returns. You see average return earned by X and Y is 15 and 14 respectively. So 15, 14 is the security returns, and portfolio return we calculated based on the weights 14.6. So 15, 14, 14.6. So 15, 14, 14.6. Risk-free rate 10. So this is the risk premium divided by standard deviation. Standard deviation. Okay. Remember in the first part of the question, what we have identified is variances, but we need standard deviation. So let me do one thing. Here only let me do a square root of this and calculate the standard deviation. So variance of X 4.8. So what will be standard deviation of X? Square root of this. Square root of 4.8. 2.19. Similarly, variance of Y is given. Standard deviation of Y, square root of 4.25. 2.615. 2.06. 2.06. And portfolio, I'll go with this number only, what we have calculated with Markowitz. I'll just go with this. As I told, if you want Sharpe ratio, you can using that also. I'll go with the Markowitz 2.115. So I'll divide by, this will be 2.19, 2.06, 2.115. Okay, so this will give us the Sharpe ratio. 15 minus 10 divided by 2.19, 2.28. 14 minus 10 by 2.06, 8.24. 14.6 minus 10, 14 minus 10 by 2.06, sorry, 1.94. 1.94, 14.6 minus 10 by 2.115, 2.17. Sharpe ratio, Taylor ratio, Jensen's alpha, all are higher the ratio the better. So if they sometimes they ask you to rank, so if you rank them, MFX would come first, portfolio would come seconds, and MFI comes thirds. Anyway, fine. Coming to trainer ratio, the denominator will be, instead of standard deviation, denominator will be beta. So numerator is going to be same, 15 minus 10, 14 minus 10, 14.6 minus 10, divided by beta calculations. Okay, beta of x and y, 1.087, 0.903, 1.087, 0.903, and portfolio beta. Portfolio beta we calculated as 1.013. 1.013. So 15 minus 10 by 1.087, 4.60. 14 minus 10 by 0.903, 4.43. 14.6 minus 10 by 1.013, 4.54. So basically, Sharpe ratio tells you the risk premium for 1 unit of total risk, whereas trainer ratio will tell you the risk premium for 1 unit of systematic risk. Let's go to CAPM return. That is return of portfolio. What we got, 15, 14 and 14.6, and I have to subtract by expected return, required rate of return using CAPM. CAPM return we already calculate, expected return. So 12.174, 11.806, 12.174, 11.806, and portfolio 12.026, which we are getting it as 2.826, 2.194, 2.74. So this basically represents the extra return over and above what its risk it's supposed to be given by the mutual funds, given by the securities. Okay, let's move forward. This is a problem on portfolio rebalancing. Very simple concept. Let's try to do it. Mrs. Karan, Miss Karan had a surplus, Kiran had a surplus fund of rupees 2 lakh on 31/3/2016. She is interested in constructing a portfolio of shares of the core sectors to be weighted equally in rupee value terms. Her friend Shaila, based on her research, advised her to purchase the following shares: OHATRT, number of shares, price per shares. On April 1st, 2016, the prices of these stocks were as follows: OHATRT. You require to exhibit how Kiran can rebalance her portfolio on 1/4/2016 so that her exposure of individual stock is maintained on original level in terms of rupee value. A simple concept. Portfolio rebalancing means you start with a portfolio with an objective. For example, let's say this problem, I want to invest equally in all 5 stocks. But after a period of time, the price will change. Now, when the price will change, the value of investment will change. It will not be equal investment, right? Initially, when you make an investment, it will be equal. But subsequently, because of fluctuation in the market price, the value of investment will not remain same, due to which the weights also will change. So when the weights changes, you have to come back and keep the equal weights again. Realignment. Simple words. Realignment is portfolio rebalancing. So some stock would have gone up, some stock would have come down. So whatever excess amount, you take it out, and whatever shortage amount, you keep it, so that again equal amount can be maintained. In real life, it need not be a equal weightage every time. For example, you invest in 3 stock, 40%, 40%, 20%. It's not equal, 40, 40, 20. But when the weights changes because of market fluctuations, again at the end of the year or at the end of 3 months, maybe you want to put again 40, 40, 20. So 40% would have become 41%, 20% would have become 19%. So take out from the excess, put it to the shortage. Again, the original objective is maintained. That is portfolio balancing, rebalancing. In many other situations also this might apply. For example, Nifty 50, we say 50 companies. Sensex 30 companies, we say portfolio. Sensex started in 1979. And till today, do you think all the 30 companies remain same? No. Some stock would have gone out of the index, some stock would have gone into the index based on some parameters. So based on some parameters. Let's now go ahead. But the Sensex need to review that, right? At particular point in time, let's say 6 months once, or let's say yearly once. Okay, these stocks have failed to meet the criteria, take that out of index. That will be replaced by this constituent, this share, like that. Anyway, so let's understand this process now. Just give me 1 second. Okay. What process we are going to follow is this. We will calculate number of shares into the market price. We'll give you the value. Now, this will be our current value or current portfolio. But we want to revise the portfolio. What is our revision portfolio? Based on the objective. In this problem, objective is equal weights. So you compute the value, then you realign, that is equally allocate. Then you see the difference between the current and target. If the target, whatever the difference may be, plus or minus. I'll explain to you how it works. So first let me explain, then you can take it down. First let me explain. Okay, what are the current prices? When you invested, it is 400. 440, 125, 100, 200, and total investment 2 lakh. So when you invested 2 lakh, this is how allocations have been done. Is it true? Let's check it out, because they said equal weights. Is it equal first of all? If I calculate 100, you don't have to calculate the old price, but I'll just do it for your reference. 100 into 400, that is 40,000. 1000 into 40, 40,000. 320 into 125. I think 40,000. 400 into 100, 40,000. 200 into 200, 40,000. So total 2 lakh. That's what they've given actually. So this information, this table is not relevant. This is existing information. 2 lakh divided among 4 stocks, 40,000 each. 5 stocks, 40,000 each. That we already verified. So what we are going to do? New value. That is number of shares 100,000, 320, 400, 200 multiplied by 300, 60, 120, 150, 125. Let's multiply the new price. Number of shares given, new price per share 300, 60, 120, 150, 125. Second table. So what will be the revised portfolio value? 100. Don't write it. I'll give it a turn right. 100 into 300, 30,000. 1000 into 60, 60,000. 320 into 120, 38,400. 400 into 150, 60,000. 200 into 125, 25,000. Total 2,30,400. You see, amounts are not equal now. Now the 2 lakh is not relevant. The 2 lakh is gone now. Don't worry about, oh, 2 lakh was there, 2,13,400. What to do with 13,400? Don't think those things. Simple approach. What is my today's position? My value is 2,13,400. That is my portfolio value today. Correct. What is my objective? It should be equal in all the stocks. If 2,13,400 should be equal in all the stocks, that's what is called as rebalanced portfolio in alignment with my objective. Divide by 5 equal weights. It should be 42,680. Understood the process? So this revised value of portfolio is our current situation. But as per my objective, it should be as per this number. So if 30,000 should become 42,680, that means I need to purchase. If 60,000 should become 42,680, that means I need to sell. And how I got 42,680? 2,13,400 is equal weights. So divided by 4, divided by 5 stock. That's how I got 42,680. Practically, it might be like 20%, 30%, 40%, whatever the target weights. That percentage I multiply, I get the rebalance portfolio. Then the current value of the portfolio and rebalance portfolio difference is the purchase or sales. If rebalance portfolio is higher, that means I need to purchase more. So it is plus. Purchase means plus. Basically, you can do rebalance portfolio minus current portfolio. If it is minus, it is to be sold. It should be 42,680. It is only for 60,000. So subtract 42,680 minus 60,000. We are excess now. So subtract sell. Just 42,680 minus 38,400, 4280. 42,680 minus 60,000, 17,320. 42,680 minus 25,000, you get 17,680. And at the end, it will definitely be 0. You can verify. Because ultimately we are taking out from one and putting it to another's. If you want number of shares to be purchased or sold, value, you know, how much value you need to purchase, how much value you need to sell, that amount is here. You just divide by the price per share. This column, 12,680 by 300. You get 42 shares. Round off you can do it. 17,320 by 60 shares. 288 shares you can do it. I mean, I'm giving a decimals, you can round it off because you know fractional shares cannot exist. So the purchase value, sales value divided by the new price will give you the number of shares to be purchased and sold. Okay, so let me do one thing. Let's start fresh. Okay, so you calculate here till here. You calculate now. So company, number of shares, new price per share, multiply, you get the value of portfolio. So please calculate, then I'll show you the remaining columns. I explained overall, now we'll do it slowly. Okay, so let me show the numbers. 30,000, 60,000, 38,400, 60,000, 25,000. Total 2,13,400. Okay, then rebalance portfolio based on our objective. Realignment is a better word. Realignment. 2,13,400 should be divided equally. So divide by 5, 42,680. Rebalance portfolio minus revised portfolio is purchase or sales. Rebalance portfolio minus the revised portfolio. If the answer is positive, that is going to be a purchase. If the answer is negative, that is going to be a minus. So rebalance portfolio minus revised portfolio. Then this amount divided by price per share will give you number of shares to be purchased or sold. A very simple concept. And practically it's very, very relevant. Once you define your portfolio, you can't just sit forever. This is my portfolio. You have to review it because some news would have come. Company which you thought performing well might not have performing well. You might need to exit that company share. So review, assessment. That is what is portfolio rebalancing. So we do many more things in practical life, but here we are just limiting for one thing. We want to be equal weighted. Okay, so hope it is done. I'll go further. Next problem looks complicated problem, but if you understand the basic structure, simple one. Equity of ABCL is rupees 500 crores. Debt is worth 290 crores. Printer division is attributable to 64%, which has an asset beta of 1.55, and balance value is applied on space and consumable division, which has an asset beta of 1.4. ABCL debt beta is 0.28. You require to calculate equity beta. Ascertain equity beta if ABC Limited decides to change its debt equity position by raising further debt and buying back of the equity to have its debt equity ratio at 1.5. Assume the present debt beta is 0.45 and any further funds raised by way of debt will have a beta of 0.50. Whether new equity beta justifies increase in the value of equity on account of leverage. So this is all about beta, means risk, you know. But if you understand through sentences in the row format, it will not be clear. Let's try to understand this in the balance sheet format. Okay, first let's focus on the first part of the question. Okay, so balance sheet formats. So balance sheet means, you know, there will be two parts. That is source and application, that is liabilities and assets. Now source, what is the source of this company? They have 400 crores equity and they have debt over 290 crores. Okay, source, they have equity and they have debt. Clear? Now application, what they have? Assets. They have printer division and they have spares and consumable division. So you have printer division and then you have spares and consumable division. Spares and consumable division. Now printer division, they have given the weights or the beta. Beta of printer division is 1.55. Beta of 1.55. So printer division has got beta of 1.55 and spares and consumable division has got a beta of 1.4. And they have given debt beta. You see, debt beta of 0.28. Debt beta, this has got 0.28. And they're asking basically what is equity beta. Simple framework have you got? Source, application. On the application side, they have given both the betas. On the source side, debt beta is given, equity beta is not given. What is debt beta? Usually we assume debt beta is 0 because usually we assume that is risk free. But sometimes, when the debt yield is more than the risk free, that means debt has got some sort of risk from the investor point of view, and it will have some beta. But you don't have to worry about it now. They only have given. And when you understand this balance sheet, don't try to apply literal approach. What is literal approach? Balance sheet asset equal to liability. So 1.15 plus 1.4 minus 0.28 balancing figure. Don't literally apply balance sheet approach. We should always convert this into an average. And this average should be equal. Because ultimately, we are not adding everything line by line. We are going to do an average. And what we are going to take it as an average? We are not going to do a simple average. We are going to do a weighted average. Do we have the weights for the asset side? They have given 64% and balance, I think 34% obviously, right? And balance. So this is 64% weight and this is balance obviously 36% weight. So what is going to be asset beta of the company, or it's also called as unlevered beta. Asset beta of the company or unlevered beta. Weighted average, very simple. 1.55 multiplied by its weight, that is 0.64 plus 1.4 multiplied by its weight, that is 0.36. Which will get you the 1.496. This is the asset beta. You can also call it as unlevered beta. This should be same thing equal to liability side. So liability side also we should do weighted average. Beta of equity multiplied by its weight. What will be its weight? Debt, equity by equity plus debt. Multiplied by, plus weighted average, no, beta of debt. BD, beta of debt multiplied by its weight, debt by debt plus equity. Weighted average. And this equity beta is also called as levered beta. Levered beta. Because it is after considering the risk. And one more point, keep it in mind. If any tax information is there, I will not take just a debt. I will take after tax because you get interest tax benefit. So it will be equity by equity plus debt into 1 minus t. And in the second part, it will be debt into 1 minus t divided by debt into 1 minus t plus equity. So basically, wherever debt is there, I replace it by debt into 1 minus t. So this is what I want to calculate. Beta of equity multiplied by equity. How much is equity amount? 500. Debt amount 290. So 500 divided by 500 plus 290. Similarly here, beta of debt, that is beta of debt is 0.28. 0.28, you have to multiply it by 290 divided by 500 plus 290. Okay, so I'm not making you use of any levered beta formula, unlevered beta formula. Hope everything is conceptual. Only concept what you have to keep it in mind is weighted average. Weighted average on the asset side separately, weighted average on the source side separately. Equate the two, you are done. Simple. Let's simplify this now. This is beta of equity into 500 by 790. 0.6329. This is 0.28 into 290 by 790. 0.1028 is 1.496. Simplify this. I hope you should be able to calculate directly. 0.1028 goes to right side. Subtract from 1.496 and divide by 0.6329. So minus 1.496 divided by 0.6329. Is it 2.2 something? I think 2.2. So first part of the question is done. Logically, no formula. Equity beta 2.2. Yeah, 2.2009, 2.2. Okay. Next. Second part of the question. Hope you have done with the first part. Ascertain equity beta. Again, they're asking equity beta. Yes, but for a change. If ABC Limited decides to change its debt equity composition by raising further debt and buying back of equity to have its debt equity ratio at 1.5. So you are going to change the component by doing two things. You are raising further debt and buying back of equity to have its debt equity ratio of 1.5. Assume that debt beta of 1 existing is 0.45. So this is going to be a change. Okay, 0.28 is becoming 0.45. There is a change. And further, funds raised by way of debt will have a beta of 0.5. That is for the new increase, incremental ones. Okay. So what is that change? Let's understand very simply. What is the current capital employed? 1 second. Okay. So what is the current capital employed that you have? You are having 500 equity and 290 debt. That is current capital employed. They want to maintain the same, but they want to change the composition. That is the ratio they want to change it. So let's calculate. Current capital employed Current what we have? Debt, equity. Debt you have 290, equity 500. So total capital employed 790. But what is the ratio? Debt equity ratio, target debt equity ratio 1.5 is to 1, right? So 1.5 debt for every 1 rupee equity. So total ratio wise 2.1. So what is target values then? Total will remain same 790. Cross multiply 790 into 290 into 790. Sorry, cross multiply. Forget about 290. 1.5 into 790 by 2.5. Simple cross multiplication. 790 into 1.5 by 2.5. 790 into 1 by 2.5. 474, right, for the first one. And 790 into 1 by 2.5, 316. This is like a portfolio rebalancing, you can say. Okay, so now total remaining 790, but composition is changed. What is composition? Previously debt we had 290, but how much debt we want to have? 474. So additional debt to be raised. 474 minus 290, 184. This is additional debt to be raised. Additional debt raised to be raised. Additional debt to be raised. 500 equity, you have to make it as 316. You understand? 500 to make it 316 means what should happen? It should reduce. And what they're telling, we need to do a buyback. So what is the difference? Of course, difference should be exactly same. 184. This is buyback. So by doing buyback, equity value will reduce. By doing additional debt, debt value will increase, and thereby the debt equity ratio target 1.5 can be maintained. This is not this chapter, this is your basic IPC level problem. Anyway, you take it down till here. Okay, hope you got it. Okay, fine. Next, what we are going to do? We are again going to calculate equity beta. But what is going to be the change? On the liability side, we had equity, debt, but now we'll have two debts. Existing debt and one more, additional debt being refinanced. What will happen to the asset side? Printer division, space and consumable division. Do you think asset side beta will change because you change the capital structure? Obviously no, right? Asset side is comprising printer and space and consumable. There is no change in that part. So asset beta will remain same as 1.496. But liability side, there is a change in composition, change in capital structure, so equity beta will change. That is why asset beta is called as unlevered beta. You don't worry about capital structure, you don't worry about the leverage, you don't worry about the loan taken. Whereas on the assets liability side, when you change the composition, you see equity beta is going to change. That's why it's called as levered beta. So the leverage will have an impact. That is why it is called as levered beta, equity beta. I hope the structure is clear. Let me rewrite the same thing. I'm going to write it source application. I will not rewrite the entire thing. Source application. Application is what we told, asset beta or unlevered beta. This does not change. What was this number? 1.496. This does not change. This will remain same only. 1.496. But what will happen to the liability side? 3 will be there. That is, you will have beta of equity multiplied by equity plus debt. Actually, I'll do debt 1 plus debt 2. 2 debts will be there. Total I know same, but still. Plus multiplied by plus beta of debt 1, because 2 debts are there. So debt 1 into debt 1 divided by, I think I write total capital employed, or if you want you can write E plus D1 plus D2 plus beta of D3, because D2, 2 debts are there, into D2 divided by D1 plus D2. Hope you are not offended by the short forms we use. It just means equity, debt 1, debt 2. We take these 3 beta, we take these 3 weights, you can multiply it by the weighted average, you get the answer. In fact, instead of solving in a tabular manner, you can also write in a tabular manner. Source, equity, beta multiplied by weights, product, total. We have applied that concept also. That also you can follow it, no issues. So you can follow a tabular format. You can write in a horizontal format. So beta of equity we would like to simplify. Equity amount. How much is equity amount? We had 500, 184 buyback, so it's going to be 316. Okay, 316 will be the equity amount. 316 divided by total, I'll write directly, that is 790. Then beta of debt 1. What is debt 1? The second part of information has different number, mind it. We have got values as 0.45 and 0.5. Beta values are 0.45 and 0.5. Multiplied by debt. How much debt? Existing debt. Existing debt remains same, 290, and new debt comes, that is 184. 290 and 184. Of course, total it is 474, but both will have different risk. Divide by total 790 obviously. Divide by total 790 obviously. That should be equal to 1.496. So this is equal to 316 by 790, that is 0.4. So 0.4 beta of equity, 0.45 into 290 by 790, 0.1652. 0.5 into 184 by 790, 0.1165, 1.496. Now you should be able to calculate these 0.1652, 0.1165 goes to right side, you subtract, then divide by 0.4. So equity beta equals 1.496 minus 0.1652 minus 0.1165 divided by 0.4. I think 3.03 something. 3.035. Okay. So beta of equity 3.03. How do we do weight of debts, both old and new? We take both of them, no, separately. weight of debt 1 separately, weight of debt 2 separately. Hope you're able to understand. See, ultimately we are having 790 as the total. What is the source of 790? Equity will be 500 we had, 316 we bought, 316 we want to be there, 184 buyback. So basically equity will remain with 316, 184 we do buyback. Debt 1, existing debt 1, 290 will continue, and new debt we raise, that is 184. That's what 290 plus 184 becomes 474. But 474 I will not calculate separately. I will not combine it. 316 is the weight of equity. 290 is the weight of debt 1. 184 is the weight of debt 2. So equity I keep it separately, debt 1 I keep it separately, debt 2 I keep it separately. Of course, if I do debt 1 plus debt 2 I can do, but they have separate betas. So that will be a confusion. The one more average will come for that. Average for debt 1, debt 2, then average overall will confuse further. Keep it very simple. Equity, weight multiplied by its beta. Debt 1, weight multiplied by its beta. Debt 2, weight multiplied by its beta. I hope it is fine. 3.303. They've asked one more question also. Whether new equity beta justifies increase in the value of equity on account of leverage. Value of equity we have not really computed. So we'll just focus on comment related to risk. Now, you have increased beta, right? I mean, you have increased the debt, right? You have additional debt is issued and equity bought back happened. So basically, you have taken more loan now. Increase the debt, reduce the equity. So when you increase the debt equity ratio, obviously it means you are taking higher risk, and that higher risk is reflected in higher beta. Because previously you are having 1.49, 2.2 beta, sorry, and now you're having 3.03 beta. So basically means because you're increasing the debt equity ratio, higher risk reflected in higher beta. So you can write down, higher beta is justified, higher beta is justified, higher beta is justified because of higher risk. Higher beta is justified because of higher risk reflected in because of higher risk reflected in high debt equity ratio, reflected in high debt equity ratio. Hope you got it. So basically we are telling higher beta means we are telling higher risk, which means we are telling because we are telling it is higher debt. So higher debt should compensate more return for shareholders. Expectation. Whether happens or not, only time will tell. So because of higher risk, the shareholders will expect higher return. Okay, hope you're done. Okay, let's go further. Next question. K Limited has invested in a portfolio of short-term equity investments. You're required to calculate the risk of K Limited's short-term investment portfolio relative to that of market from the information given below. Why is this relative coming? Not only to trouble you in life, in this problem also relative is coming. Risk of portfolio relative to that of market as compared with the market in response with market as a sensitivity with respect to market movement, nothing but calculate beta. They could have told you compute portfolio beta. That's what they are. Investment, number of shares, market price, beta, expected dividend yield. Current market return is 20%, risk-free rate is 10, RMRF given. Advise whether K Limited should change the composition of portfolio. If yes, then show how. Make the calculation up to 4 decimal points. Okay, let's first calculate the top paragraph. We have to calculate portfolio beta. You know the process. Weights multiplied by beta. The weighted average is portfolio beta. How do we calculate the weights? Not based on number of shares, based on value of investment. So what should be our process? Number of shares into market price. We get the value of investment. Then divide by then you do the total. The value of investment divided by total investment give you the weights. Multiplied by beta, we get the weighted average. So let's do that process first now. Okay, so you can repeat the columns like this. Okay, security ABCD, number of shares they have given. We'll multiply it by market price per share, MPS. That will give you value. Okay. So how do we get the value now when you multiply? I think you get these numbers. I hope I need not explain this. Market price, number of shares, 12,000 into 8.58 is 10,29,600, like that. Then the weight, 10,29,600 is the value, divided by 44,02,000, that will give you the weight. So 4 decimal, as they told, we can take it. In fact, from the value also you can multiply by beta, but let's go for the weight calculation. So beta, what we get? I hope I'm showing the weights. Hope you're able to calculate. Beta is given. So we'll do a product. I think 2.9355. That's what we get. Hope these calculations are straightforward. I'll still tell you once more. So 12,000 into 8.58, 10,29,600. Like that you do for every security. You get the total. 10,29,600 value of investment. Divide by 44,02,000 total investment. Value by total will give you the weights. Like that I've done for all the security. Beta is given. You need to weight the weighted average. So multiply. Weight multiplied by beta. You get the total product as portfolio beta. That is portfolio risk relative to that of market. Portfolio risk relative to that of market is 2.9355. Okay, there is one more additional point which institute gives as a solution. That also you can write it down. I'll show it to you. For that, we are going to calculate one more thing, and that is going to be uh, portfolio return. How do you calculate portfolio return here? The only return available for us is dividend yield, correct? So dividend yield, if I take an average, I get the portfolio average return. Let's calculate that. Then I'll tell you how to do the interpretation. So dividend yield, whatever returns that is there, that also you can take it as one column. Expected dividend yield, you can just say like a yield percentage. That also you multiply it by the weights. That will give the average return for the portfolio. Okay, once again, I'll just multiply it by hundreds. CAPM method we are yet to apply. We will apply. First, I'm calculating the portfolio return. Returns they have given, weights we have. I'm doing a weighted average. CAPM method also will tell you how to do it. First, let's just calculate these numbers. Okay, then do a product of this weight and dividend yield products. Okay, so what do you get here? How do you get here? 9.5 into 0.2339, 2.2221, 14 into 0.2123, 2.9772. So like that you get portfolio returns expected. So write down that part. I'll tell you what one more point institute is trying to recommend. Okay, hope you have taken down till here. Then I'll tell you what institute is doing now in their answer RTP question. What they're doing is this. We have got the portfolio beta to be 2.93, right? 2.93 we have got it. This is the present beta. They have calculated implicit beta. What is implicit beta? If the return has to be there, if the return was given already, compute the beta as the balancing figure. We are not computing the return and not comparing the return. Keeping the return of expected return and actual return both are same. Suppose both are same. What is the beta supposed to be? Implied beta. What is that? Let's calculate. We'll write an interpretation also. So using CAPM, keeping the required rate or expected rate, whatever. Keeping CAPM return, that is KE, same as average return, same as 1 second. Yeah, same as portfolio return from dividends. I hope you are able to understand what is this point I'm trying to tell. We always used to compare two things, right? What is CAPM return? What actually I'm expecting. If I can generate more return than CAPM, then I'll tell you good to invest, undervalued. So here what I'm doing, don't compare the two returns. This return, what you're expecting, put it in CAPM return and compute the beta as a balancing figure. So what happens? I hope I need not write the formula of CAPM. You should know it. Return, I am making it as 12.3789 equal to risk-free return. Risk-free return is 10%. Market return is 20 minus 10 into beta. So what is the beta? Simplified calculation, you do it. So implied beta is 12.3789 minus 10 whole divided by 10. Point 238, something approximately 0.23789, 0.2379. Okay, so basically it means the current portfolio beta is 2.93, but looking at its expected returns, it was supposed to have beta of only 0.2379. So basically it means what? For the risk, what portfolio is taking, it is not giving enough returns, right? So based on the risk of securities, portfolio risk is 2.9355, but based on the returns expected, portfolio risk is 0.2379. So basically it means portfolio is having more risk than it was supposed to be. I'll explain once more Let's see if you're able to understand the last sentence. In exam, if at all if you want to write, you should write only the last sentence. This previous sentence, all you don't have to write it down. Please focus. Let's see if you're able to understand. Portfolio beta, currently you're having 2.9355. But looking at the return, what you're supposed to get, 12.3789, you are supposed to take risk of only 2.2379. To generate 12.3789, you should take only this much of risk. That is what implied beta. You're supposed to take this much of risk. See what we used to do? Based on beta, based on risk, we used to calculate return. Here what I'm telling you, based on return, what is supposed to be the beta? But what is actual beta? 2.9345. Simple words, can I tell you like this? You are taking more risk than what this supposed to be. I hope you got the point. Instead of this, we can always go with regular approach. In the sense, what we calculate? We calculate the portfolio CAPM returns and we compare it with the expected return, and we tell that expected return is not giving CAPM return, so risk is not justified. We can also always tell like that. This is also fine. I hope you got the clarity. But in the examination, you don't have to write so much. You calculate portfolio beta and you say that that is risk related to rate of market. That is also sufficient. Okay. Second part of the question, I'll come to it. Whether K should change the composition, that we will do by CAPM method. What CAPM method? We compare CAPM return and dividend yield. If dividend yield is more, we say that stock should be continued. If dividend yield is less, then we say that that stock should not be continued. You know, when we say undervalued, overvalued, buy, sell calls, those kind of things. So let me quickly do it for you so that this will be completed today. So evaluation of portfolio. Evaluation of portfolio using CAPM. First, let me do at aggregate level. At portfolio level. Then I'll come to the individual security level. Simple things. What I have to compare? I need to have CAPM return. And then I'll compare it with dividend yield. Dividend yield. CAPM return is treat like a cost of equity. For your reference, I'm telling. Dividend yield you treat like an IRR. Cost, if it is less, IRR is more, then we say it's good to buy, good to sell. Okay, now one more column. Recommendation. Okay, so at portfolio level, what is the cost of equity is going to be? Risk-free rates, 10. I hope you don't, I can write the formula rightly. RF plus RM minus alpha into beta. In the exam heading, you can write the formula. 10 plus 20 minus 10 multiplied by beta. How much is beta of the portfolio? 2.9355. 2.9355. So how much you get? 20 minus 10 into 2.9355. Ten and 20, right? That is the correct number. 10 and 20 plus 10. 39.355. 39.355. Okay. Then what is the dividend yield you're expecting from this stock? Only 12.3789. So what do you think at a portfolio level? Is it giving the justified return? For the risk undertaken, it was supposed to give you 39% return, considering its risk. But how much is likely to give? Only 12.38%. So it's not providing the enough return. So we say it require. I mean, we should not say sell the portfolio like the way we give like the way we give it for security. We just say risk is not justified. It requires change, or we'll just say that portfolio requires change. Change in composition, whatever you can say. Portfolio requires change. Why portfolio requires change? You can say like because risk is not justified or return is not justified. Return is not justified because return is less, or risk is not justified because risk is more. You can analyze in both ways. Then at security level, individual security we have A, B, C, D. Okay, let's quickly calculate CAPM return. Everywhere only beta will change. So 10 plus 20 minus 10 into beta only will change. So other things, let me just copy down quickly. Okay, so what are the beta values? 2.32, 4.56. 1.83. So what is supposed to give you CAPM returns? 10 into 2.3 plus 10, 33. 10 into 4.56 plus 10, 55.6. 10 into 1.8 plus 10, 28. 10 into 3 plus 10, 40. Hope these are the numbers you are getting. 33. 55.6, 28, 40. Okay, 33.2 I think you get for the first one. 10 into 2.32. Okay, 23 point. No problem. Okay, these are the CAPM return. And what is the dividend yield of these things? You already have it. $9.5, 14 and all. So let's do a recommendation. What do you think is the first situation? What is going to be? 33.2 it was supposed to generate, but in the second situation, you're having only dividend yield 9.5. Is the risk justified? Obviously not. So we should say that it is not justified. Our recommendation is to sell or exit. Second case, 55.6 it was supposed to give. 14% it is giving. Again, you have to sell. 28 is supposed to give. 7.5 it is giving. Oh, you have to sell everything, is it? Oh, everything is sell, I think. There's nothing to buy. So we can say that all investments are overpriced. All investments are overpriced. I think then our recommendation should be to exit the portfolio completely. At least if one or two securities are buy, you could have shifted the money there. But here, all the securities are overpriced. So it's better to exit the portfolio completely. I have two observations here from practical point of view. From the explanation point of view. I'll just take 2 minutes. With that, we'll complete this problem. One point, just like what I did previously, what we did, we calculate implied beta, right? And compared with actual beta. I can do that also at security level. Institute has not done, but we can do it. That is, keeping this amount as 9.3, 9.5, keeping this amount as 14, keeping this amount as 7.5, keeping this amount as 16, you calculate the implied beta. When you calculate the implied beta, that will be definitely more than actual beta. So basically, you're taking more risk than what is supposed to be. Even our conclusion will be sell, sell, sell only. I don't recommend go by that method. I just told you, you can also follow that. Second point, in reality, I'm telling, not from exam point of view, taking only dividend yield is not the right comparison. Why? Because return for a shareholder is not only dividend yield, even price return is your return, right? We write P1 minus P0 plus D1. So P1 minus P0 is also important, not just D1. So in practical life, we should not take only dividend yield, we should also take price returns. We should take only the total expected return, including price, including dividends. So that's why considering only dividend may not be appropriate. But from exam point of view, if this question comes, we don't have information about the price returns, right? Because they have not given what is likely to be the price of security. So dividend yield assumed to be, dividend yield is assumed to be total return. So we are assuming there is no price returns. So then this answer makes sense. So understand what assumptions you are making from exam point of view. You should make the same thing even when you write the exam. We have only information about the dividend yield. We don't have information about the price returns, the price movement, P1 minus P0. So we assume dividend yield is entirely the total returns. Okay, somebody wants previous slide. I put the previous slide. Okay, so I hope this question is complete and RTP problem.